Hey everybody, it's Michael, and I work for a law firm called the Investments Lawyers, where we form investment funds and SPVs all day. You can check the link in my bio. Today we are going to talk about investment fund waterfalls, which people can get confused about sometimes. They are kind of confusing. This is a serious video, so I'm not going to be making too many jokes. I have my glasses on, I'm very serious. I do have the hat, which should help a little bit. But let's dive in here. So what is a waterfall? A waterfall is a provision that says when we, the investment fund, have money to distribute, how do we distribute it? In which order do we distribute it? So let's take a look. So here we have a bunch of assumptions up here, and down here we have something that spits out how much money everybody gets. So let's say here that the GP is going to put in 1% of the capital, so the LPs put in 99%. Let's say we have let's say we have a 10 million. Let's make the numbers easy here. Let's say we have a $1 million fund. Let's say we hold the thing for 4 years, and we have a 2x multiple. Let's say we have a preferred return of 8%, kind of a common preferred return. In this case, we're saying the preferred return is compounding. Sometimes the preferred return is not compounding. It kind of depends on the fund. Okay, so these are assumptions. So we put in $1 million. In 4 years, we 2x'd it, so now it's $2 million. So where does that $2 million go? So down here we have some clarifications. The GP put in 1% of $1 million, which is $10,000. The GP put in 99%, which is $990,000. So now where does this money go? So down here, the first step, which isn't even really technically in the waterfall, is the GP gets back the money it put in as capital multiplied by the multiple. So in other words, the GP put in $10,000. We got a 2x multiple. So now that 10,000 got turned into 20,000. And so the GP just gets that. That does not go through the waterfall. Look at this, does not run through the waterfall. So that just goes into the GP's bucket. The waterfall is really for the LP's money. Where does the LP's money go? And what the waterfall is it's basically the GP taking some of the returns from the LPs. That's what the waterfall really is. So first the GP gets their 20K. Over here I have like a little running list. How much left to distribute? $2 million. 20,000 went to the GP. We now have this amount left, $1,980,000 left. So the first step in the real waterfall is return of capital. And this means the LPs get their money back. So the LPs put in $990,000. They get $990,000 back. Step one. Now it happens to be that we only have $990,000 left to distribute. And this is the profits, This is the profits attributable to the LP. Where does that go? So first, we have what's called a preferred return. And what a preferred return is it's the GP saying, you know what, LPs, for investing in this fund, after you get the return of capital, you also get an extra return on your money before we, the GP, start taking any money. So in this case, we have 8%. So the GPs are basically making 8%, in this case compounding, on their $990,000 for a period of 4 years. And that happens to be this amount. $356,884. I said that in a weird way, please forgive me. Now, if the preferred return is 9%, then that's more. If the preferred return is 3%, then it's less. If the holding period is, 7 years, then it's more. You can figure this out. I have faith in you. Longer period, the higher the preferred return rate, the more preferred return they get. So in this case, I switched it. Now the preferred return is 6%, hold period of 4 years. The LP is going to get that amount. So in this case, they have a 6% compounded return for 4 years. Now, this is the tricky part, the GP catch-up. Okay, so the ultimate goal is that the GP is going to get 20% of the profits. That's the 20 and 80. That's the 20 and the 80-20 waterfall, and the LP is going to get 80% of the profits. So that's pretty common. And so the idea here is, for every 4 steps that the LP takes forward, the GP takes 1 step forward. Does that make sense? So basically 80%, 20%, 4 steps, 1 step. Now the idea here is that the LP already got to take some steps. That's step 2. Step 2, LP got to take some steps forward. The GP, you see, there's nothing here. The GP didn't take any steps forward. So the GP has to take some steps forward. In the analogy, they took 4 steps, the LPs, the GP gets to take 1 step. Now I'm going to move my microphone over. Let's hope I don't do anything crazy. I'm going to be doing some bad Excel over here, so please forgive me. Now, so what we have here is we have this number, which is the profits. Remember, this isn't the profits. This is return of capital. Now, this is some profits. The GP, in the catch-up phase here, gets to take an amount such that it has received 20% of this plus this. So this plus this is $324,000. You'll see that if we take this amount divided by this, we get 0.2, 20%, 1 step forward. And the way to calculate this is just a quarter of this amount, such that now they'll have like 1 quarter out of 5 quarters is the way to think about that, which is 1 step forward for the LPs, 4 steps forward. So I'll get rid of this, but hopefully that was a helpful analogy. And then after that, it's easy. It's just 4 steps forward for 1 step forward for the rest of time. Now, sometimes people make this more complicated, which is fine. They might say, you know, after a certain IRR multiple, let's say 12%, then it's 70-30. So then the GP gets a larger percentage of profits. There might be an extra catch-up after that amount. There's all sorts of things you can do. You know, you can play around with this. You know, what if the GP puts in 5%? What if the hold period is just 1.5 years? You know, there's all sorts of things you can do. Hopefully this was helpful to you. I know this can be confusing sometimes, but this is how it works. If you have any questions, let me know. These provisions can vary wildly between different investment fund agreements. But I think this should be fun to play around with for you. It's definitely fun. I'm having fun. I think we're all having fun here. One thing to mention is that this chart is not exactly correct if the GP is not paying management fees. So sometimes there will be cases where the GP does not pay management fees. In that case, it gets a little bit more complicated. But this is a good starting point, I think, for most funds. Yeah, so let me know if you have any questions. Always happy to talk about this sort of stuff. This is what I love doing all day. Again, my name is Michael Hughesby. I have a law firm called The Investments Lawyers, and we form investment funds and SPVs all day. So hope you have a good one. Thanks for sticking around.